Hi, everybody, and welcome to this Prinsights interview with John Rubino. I am so excited to have John on here because, first of all, he graduated from the same school at NYU that I did back in the same decade. We don't have to get into when that decade was, but we definitely have that NYU Leonard Stern School of Business alumni connection. And I appreciate everyone who went through the NYU programs as well when I did. So thank you for that. But also, he has had a really interesting perspective on the markets for decades. And 2 years ago, started his own Substack, which is doing phenomenally well and which you should definitely check out. And to talk more about that and, perhaps give a little bit more about your background, John, welcome again. And how did you get from NYU to this conversation? And let's talk a bit about that first.
I know me. Well, it's great to meet you, and congratulations on your success on Substack too. It's a fun platform. But I kind of inadvertently have ended up in financial bubbles one way or another for my whole career. Ever since you and I were together at NYU, I was a junk bond analyst in the late 1980s, just as that bubble blew up. And then I was a tech stock columnist for an online newspaper or magazine in the 1990s, just as that bubble expanded and then blew up. In the 2000s, I wrote a book called How to Profit from the Coming Real Estate Bust. And then that bubble blew up. And now, here I am on Substack chronicling the end of the everything bubble and maybe the end of the whole fiat currency experiment. So it's, none of it was planned, but it's all been fun because financial bubbles are just inherently fascinating. And the big one that has happened on the stage of the fiat currency experiment, biggest in human history, which means the bust will probably be commensurately interesting when it happens.
Yeah, I mean, you've definitely lived through all of them, not just in years, but also in the analysis that you provide, the books that you provided, and really taking that perspective into what might be this current everything bubble. But you also have this really interesting way of investing into it and around it. I'm a big fan of your pieces because you really dig deep into the graphical information, putting things into historical perspective. And by that, I mean, you go back to like France in the 1700s. And I'm really interested to know how the history, long-term history, as well as past, more recent bubble history impacts your portfolio strategy.
Well, yeah, the history part is fascinating because all human history is human nature playing out over and over again in the same way because we're the same entities from one century to the next and we make the same mistakes. So you can learn a lot about looking at financial bubbles of the past and how they ended. And in that sense, where we are right now is incredibly familiar. It's no different from Rome's hyperinflation or Weimar Germany in the 1920s or France. They had two hyperinflations in 1 century back in the 1700s. And it all looks kind of the same, which gives somebody who knows the history some confidence that it's going to play out the same way because we are still the people that we are. We're over emotional. And that leads us to do things that are very unwise in the heat of the moment. And then the system kind of crashes down around us. So same thing coming now. Now, as for investing for this, history plays a role here too, because in each of the big financial crises of the past, most people really suffered and a handful of people did really well. And in the currency crisis specifically, where a country decided to start debasing their currency in order to fight wars or win elections or whatever, and they brought about an inflation, in every case, the people who made out, who protected themselves and ended up building capital through the crash of that currency, were the ones who went to real assets at the right time. They bought farmland, they bought oil, if to the extent that there was oil available. That's a recent thing, but gold and silver in particular go all the way back to the Roman Empire and before. If you had gold and silver coins during the Roman hyperinflation, you did great because they held their value or they went up dramatically in local currency terms. And if you were in copper coins, which were being debased, or pretty much anything else that involved you trusting the government, you got burned big time. So no different today than in all those other times. So a portfolio of commodities, in other words, real assets that governments can't make more of in on a printing press or electronic printing press, will probably do really well versus the local currencies. There's one big difference this time, though. In the past, in past currency crises, it was usually one country screwing up on a stage in a world of sound money. In other words, most people were on some version of the gold standard back then. One country would decide that they had some advantage in inflating away their currency and using that money to fight wars or whatever. So they went ahead and did it. The currency collapsed and their people suffered. But the rest of the world kind of went on because it was business as usual financially for them because they were all on the gold standard and their money held up well. This time around, it's global. Everybody is on a fiat currency system, and we're all in our own way inflating away our currencies. So the boom is global, which is part of why it's lasting longer than it really should have based on historical numbers. And the bust is probably going to be bigger and more widespread because there's virtually no place to hide from this geographically. Every country, almost, with the possible exception of Russia, interestingly, they all have fiat currencies. They're all building up too much debt. They're all creating too much new currency to manage that debt. And they're all going to see a plunge in the value of their currencies when people finally catch on to what's happening and just bail on those currencies altogether. The people, meanwhile, with real assets, the guys who own lots of farmland, like Bill Gates, the billionaires are buying farmland like crazy right now. And they're doing that because they see what's coming. Or the people who own energy assets, like Warren Buffett is the biggest buyer of Occidental Petroleum right now. He's got something like 35% of a multi-billion-dollar company. And the people who own gold and silver, like the big central banks of the world, who are aggressively buying gold and, to an extent, silver, because they see what's coming. At least the non-Western central banks see what's coming. So you're seeing what we could categorize as smart capital or into real assets. And as individuals, it makes sense for us to emulate those guys, just do what Warren Buffett and Bill Gates are doing, or the Chinese central bank or whatever. And you're probably on the right side of history. So yeah, on Substack, I set up a portfolio that has assets in the different commodity categories. And it's been interesting so far because, gold has gone up just like you would expect. And the gold ETFs are doing really well, but the gold miners are not. And so there's, somewhere in the thesis is a flaw that has to be dealt with. But, the uranium stocks are doing great. And oil hasn't done well lately, but they're high dividend stocks, so they'll probably be fine. And so on. So in general, a commodities heavy portfolio is doing pretty well so far. So it's turning out to be a decent place to hide in the early stages of a currency crisis, which is clearly coming. And it'll probably be a great place to be in the later stages of it when things get really crazy.
Yeah, it's interesting because you also have an archive of all of the articles you've written around your portfolio, basically on the strategy of real assets upon which your portfolio is based. And you've been prolific in the real asset, overall economy, and energy spaces, which are basically all the three main spaces that you have to look at, and you have to be cognizant of whether you're Warren Buffett or an individual investor. And it's interesting you mention, and you have in some of your write-ups on rubino.substack.com, which people should definitely check out. Check out John's portfolio, check out his analysis. Recently how, the mining stocks, particularly gold mining stocks, have underperformed gold assets, where at the same time, and I agree with you on your overall thesis, gold is a very good hedge for any fiat currency destruction and in general, any major transformation economically, to come in the world. So what is that gap about? That gap reduced significantly in the middle of the year, and it's increased by a lot in the last month and a half, really since just before the election. And why do you think that the miners that are producing the gold that's in demand by the central banks from China to Russia to India and so forth have seen some of this underperformance recently? And do you think that's just a matter of preference of the more liquid capital, looking at, your Nvidias, or you're just other stocks for now, and just being a little less interested, particularly in the West, in the miners versus the underlying commodity? And will that change?
Well, gold mining stocks are normally called leveraged plays on the price of gold in the sense that they tend to be more volatile than gold in the same direction as gold. So if gold goes up, the miners should go up by more. And in a lot of cases, that's not happening right now. And I think there are two reasons for that. One is that mining has become a harder business lately than it used to be. The grades are falling. In other words, we've found a lot of the low-hanging fruit when it comes to mining because we've been seeking gold and copper and silver for 3,000 years. And so the easy stuff is found. And what they're finding now, the new deposits, are not nearly as economic as the old ones. At the same time, labor costs are going up in the mining space. There aren't that many mining engineers out there that as there used to be. So the guys who are retiring are harder to replace and more expensive to replace. So a lot of the rising revenue that comes from a higher gold price, for instance, doesn't flow all the way down to the bottom line for a lot of the miners. So they're not reporting the kinds of numbers that would normally light a fire under that kind of a stock. That'll probably change though, because gold is still up sequentially. Second quarter numbers were pretty good for the miners because gold had gone up. Third quarter numbers were better in general because gold had gone up some more, and gold is up even more now than it was during the third quarter. So fourth quarter numbers ought to be even better for the miners, and at some point that does light a fire under them because when you get strong earnings momentum, it shows up on a lot of screens of generalist investors who don't necessarily care about mining, but they see the numbers rising. And so you see that extra outside money flowing into the miners. They're basically a small market compared to the rest of the world, and that will help their prices. So I'm still optimistic that the miners are going to do okay. But there's another reason why miners, which are kind of seen as speculative by a lot of people, and in some cases they are, speculative investors have a lot of other choices right now. There are a lot of bubble assets out there, Nvidia and Tesla, and what Bitcoin is at an all-time high, and now the AI bubble is fading a little bit, but it's immediately being replaced by the quantum computing bubble. So if you're somebody who wants to throw money at momentum, you've got a lot of other places to look besides the gold miners. Now, those other bubbles are due to burst. Although I can't speak for Bitcoin. I just do not understand it well enough to say anything that isn't risking being embarrassing when it's out there on a video. So I don't know about Bitcoin for sure, but tech stocks in general are wildly overvalued, and there's no way that they continue for very much longer at these valuation levels, and with market breadth being as narrow as it is and everything. So there's an equities bear market coming out there. And more than likely, the overvalued assets will be the things that really get burned. And the things that are still relatively cheap today will be damaged less. So the miners will do relatively well compared to tech in probably the next year or two. And then when the central banks of the world step in and start liquefying everything in sight, that'll light another fire under gold and silver, and probably carry the miners along with them this time. So it's still a good time to be buying gold and silver miners, but you risk correction in the short run. But it's probably one of those V-shaped things that bounces off the bottom and then heads to the moon. So I'm still adding gold and silver miners, but sticking with high quality right now because the year ahead is probably a little bit risky.
Yeah, it's interesting because I know you just had a recent piece out, well, about oil and also about copper, and that idea of, again, there's a little bit of a time gap. But if we look at some of the gold miners, for example, a lot of them also own copper mines, or they're partially invested. There's a lot of sort of synergies throughout the space. And as you mentioned, it's a question of investors, particularly momentum investors, having a lot of other choices, but at the same time, real assets require real mining. And at some point, there has to be that pull because you can't continue, at least physically, to have those assets without having the ability to take them out of the ground, process, and produce them. And if we move it to the energy space, which you've written a lot about as well, and looking at something like copper, we also have that other transformation that's a long-term transformation in terms of the necessity for more power grids, for more copper wiring, and an AI requirement on copper that is exponentially increasing with data centers and all of our AI needs. And so it is a long-term investment. So you've talked about being cautious along the way, but is your thesis sort of similar, um, with caveats for the copper space?
Oh, yeah. If we are going to do the things that we intend to do, there's nowhere near enough of a long list of commodities to make that happen. Copper's a good example of that story. If we're going to set up all these AI data centers, which we apparently are, and all these nuclear plants, which we apparently are, then you've got to ship that energy from one place to another, and you need copper for that. Same thing with electric vehicles. They use 3 or 4 times as much copper as an internal combustion engine car. So we need a lot of copper. And there's in one of the things I just published on copper, there was a graphic that showed over time the size of the new copper discoveries. And back in like 1900, there are these giant deposits that were right at the surface. You just strip mine that land and you send it off to a smelter and watch the money roll in. And as time goes on, you see the deposits get smaller and deeper, which means we're basically running out of easily accessible copper. At the same time, we're going to use orders of magnitude more copper to do the things we want to do. So when those two things collide, you have to get a much higher price. And that's the copper story right there. Same thing with silver. We're already in a deficit with silver. And there are all kinds of new uses for silver out there, including the monetary use. When gold goes way up, silver is pulled along. But there's nowhere near enough silver, not even today, let alone 5 or 10 years from now, to satisfy those needs. So the price has to go way up to incent miners to go out and get uneconomic deposits. And that math is pretty inviolable. It has to work out that way unless we completely change the course of financial society right now. In other words, if we decide, okay, no more nuclear plants, no more AI data centers, then okay, we don't need as much copper or silver. But if we keep on doing those things, we need massive amounts of copper and silver and lots of other things. And those things become good investments just because their supply is inadequate for the demands that we intend to put on them, So it's a very easy to understand thesis, which is nice because a lot of the investment ideas out there right now are very hard to understand for me. So commodities are simple enough that it's easy to be comfortable that the story is true and it's really going to play out that way. And so, yeah, I think commodity portfolios in general are going to be things that are easy to understand, that might pay some dividends along the way, and will probably go up in price over time.
Yeah, it's interesting because you were just talking about the NVIDIAs and so forth, and going back to your, if we have a crash on all these other things, well, if we were to stop AI, if we were to stop energy, neither which isn't going to happen, then you're going to get a more massive crash in the AI stocks than you would in the commodities that take longer to basically get themselves generated into the needs of the economy as it is, forgetting about transforming it in any way, which we are. So I think, that probably also is a reason why commodities make sense. We're very much about real assets. I've been about real assets, not that there are opportunities in tech, there are, but also in some of the areas of tech and AI that can potentially be connected to commodities. So for example, if it's more expensive to drill when the time comes to a copper, uranium, or whatever mine, to what extent are some of these AI technologies, or are they on your radar, that can help with the cost and the effectiveness and the efficiencies and the cleanliness of producing those assets as and when we need them? And is that something that you're also looking at as connected to that story?
Well, AI has the potential for improving everything, except maybe humanity's survival going forward. But as far as industries go, yeah, we can do a lot of things much better if we have an artificial intelligence that's able to figure things out in ways that humans can't do. Okay, that probably works. But when you're dealing with physical things, there's only so much you can do. Like getting to a deposit of some metal that's 1,000 meters under the ground. Okay. Um, there isn't all that much you can do to save on the cost of that, because you need, it's physics. You need X amount of energy to get that far down and do the things you need to do down there. And so AI might help with finding things like that. And it might help with the efficiency of smelting things, and might make engines more efficient to get down. And, so it could do some things at the margin.
Sure.
But physical stuff is still governed by the laws of physics, and it's going to be increasingly expensive to get at less and less economic deposits of most things.
Sure.
And AI can moderate that increase in expense, but probably can't do away with it. So I think that, cost increases in the mining space are kind of baked into the cake. And the only thing that really fixes them is much higher prices. So
Right.
I think that still happens. But yeah, the AI thing and the quantum computing thing. I mean, you saw Google's quantum chip, right?
Yeah.
Where they claim that it operates in the multiverse. It spreads its computing out to parallel universes. I wouldn't even want to venture a guess about what
How
that
do you
means.
prove that wrong? Exactly.
Yeah. And if it's true, how do you incorporate that into cost projections for an industry? I have no idea.
Yeah.
But actually, one interesting angle there is that quantum computing threatens encryption. So
Sure.
a lot of industries are right now trying to harden their encryption against the day when quantum computers come along and could just clean out the bank accounts and the Bitcoin wallets of people who haven't improved their encryption to that point. So that leads to an increase in the desirability of physical assets. Like gold and silver coins suddenly become a much more interesting investment if your bank account can be wiped out by whoever comes up with the next generation quantum encryption breaking program, and that's another thing we can't predict because it's uncharted territory. So that just makes me want to have more gold and silver coins, and it makes me more nervous about my bank accounts and my brokerage accounts. So that's a story for the coming decade. Probably doesn't really have much of an effect on the coming recession. The next downturn in the economy is probably going to be a old style financial bust. And what comes after, between AI and quantum computing might be unpredictable. It might be on the other side of the singularity. So I wouldn't want to venture out too far.
But again, like we know that the physicality of gold and silver is inalterable. Not if it's in an ETF, but if you have it, if it's in a vault, if you're connected to authenticated certificates of the bars, whatever it is you have, the coins, they are real, and they can circumvent cyber problems in the future. And that's one of the reasons I think central banks have been buying them, in addition to, of course, the geopolitical monetary policy, diversification away from the dollar, away from policies, and having more independence. And I think, you mentioned that at the beginning. I mean, I think that's going to continue as well. If that does, how do you see the dollar playing into that? Is it all fiat currencies underperformed? Is the dollar sort of risen by too much too far in this monetary cycle? You just wrote a piece about potentially higher for longer rates coming back into fashion maybe next year after this next Fed cut. How do you see all of that?
Okay, well, the higher for longer thing is really interesting because it's kind of immediate. The Fed is probably going to cut rates one time tomorrow. And then after that, they're going to be looking at a world where retail sales just jumped, which means consumers are still spending. Inflation is above the Fed's target and trending up now all of a sudden. Interest rates, after dropping when the Fed started cutting, are going back up again. The U.S. 10-year Treasury rate is rising fairly dramatically from its recent bottom. Stocks are at all-time highs. Home prices are at all-time highs. Bitcoin's at an all-time high. Gold's at an all-time high. That's normally the kind of environment where central banks tighten aggressively, right? Because you really risk, with all of those things at all-time highs, you risk accelerating inflation unless you rein it all in. And our central bank is cutting interest rates, and what's going on now is probably going to be an excuse for them to stop cutting interest rates in the short run. So we're liable to get a Fed pause on rate cuts. And so we're back then to higher for longer. In other words, rates stay higher than we expected for much longer. And then you got to look at stocks and think, well, okay, you can get 4.5% in a bank CD. The S&P 500 dividend yield is 1.8%. Which do you want to do in this kind of a world,
Right.
And probably a lot of money flows into short-term fixed income and out of stocks then. And that triggers an equities bear market, which triggers a recession. And which is, that's a kind of a typical thing in the financial markets, other than the fact that it would be global if it happens this time around. But, that's the kind of thing we can understand. We've seen it before. It could happen again this time. And that's probably a 2025 story because it's all happening in real time. All of those things I just mentioned are reality right now. And the Fed should, unless they've got some other agenda or they're being blackmailed or something, a normal Fed would respond to those statistics with higher interest rates. So in this case, maybe they just keep them stable, but same effect on the economy.
And certainly on the long end of the yield curve. If the economy itself is slowing, which it is. We're looking at Conference Board just came out with a 1.7% prediction on 2025 growth. Adjusted for inflation, that's kind of negative to flatline to recessive. At what point does that, you think, meet? I'm not asking for prediction on the date, but does that basically negate the inflation fear for central banks?
Yeah, I'm always too early with everything. So any date, if I were to give you a date, you should add 6 months to 5 years on it.
Right.
And then,
This is why you're a good investor, though. This is why you're a good long-term investor. That's exactly, yeah.
Well, yeah, it's good to be a little early. It's bad to be way early. So, it hasn't always worked out for me, but yeah. We if we said it was today, we'd probably be a little early, but it feels like a lot of these things are kind of coming to an end. Take, for instance, government interest expense. And it's not just the US, but it's lots of other governments where they build up this massive mountain of debt. Then they allowed interest rates to rise, or they actively increased interest rates to deal with the inflation that flowed from all the debt they took on. And then their interest costs spiked parabolically. Like the US federal government's interest cost is up to like $1.6 trillion a year and still heading higher. That money has to be borrowed, which raises the deficit, which raises interest costs even more, unless interest rates are falling dramatically. So if interest rates stay at their current level, you see interest costs all around the world start to spike, and the weaker, over-leveraged entities out there are really impaired by that. So you see bankruptcies flowing from entities, whether they're governments or commercial real estate companies or individuals who need lower interest rates to survive and aren't getting them. So I feel like that's the story going forward, because if we don't keep cutting interest rates, then these interest costs are just going to eat a lot of these governments. And, Japan's government's interest cost is going to be insane. And the same with the US. If we hit $2 trillion of interest expense per year, and we're running a $4 trillion a year deficit, which we probably will be in the near future, that's a death spiral when you compare that to the size of the economy. And we're basically there. So why would anybody? I think in the short run, longer term bonds are probably a good place to hide out against an equities bear market and a recession and stuff like that. But as soon as we bottom in the coming recession, who in their right mind wants to own the long-term debt of governments that are running deficits of 5 or 6% of GDP and seeing their interest costs just go through the roof? You don't want that paper. And that might be the end of the Well, it'll be the end of the everything bubble and maybe the end of the fiat currency experiment. So that's why this coming decade is so interesting, because we tried an experiment starting in 1971 with giving all the world's governments unlimited credit cards with unbacked currencies, and it's blowing up on us. So when does it blow up? We can't say what year, what week, within what year, but clearly there's some trends that are unmanageable, and that means we're getting closer to that brick wall. And I wouldn't be surprised if by the end of the year people were talking about, wow, are any of these currencies still useful for anything? And what are we going to do? And, that kind of a thing starts being discussed.
Sure.
So we'll see. But it's a fascinating time to be a finance nerd in the world, because
Yes.
we're making history here, and not in a good way.
Well, you're covering it in an incredibly good way. I'm a big fan of your work. Everyone who's watching should really check out rubino.substack.com. And John, before I let you go and wish you happy holidays, and again, thank you so much for being here. Do you have any final summarization takeaways for people that are either currently invested in these markets looking to get invested into 2025?
Yeah, I think, well, two things. One is that, you can look at all the stuff going on in the world and really immerse yourself in the gloom and doom. And then you don't want to get out of bed in the morning because there's so many scary things happening. But if you think of it as an investment thesis, there's a lot of scary stuff happening, but this will go up and this will go up and this will go up. And I can protect my family, and I can guard against bankruptcy and help my friends, and all the things you do, all the things a good person does with capital. Then it's kind of, it gives you a chance to be kind of optimistic about all this stuff. And it's a better mindset to have going into what's coming. And there was another thing I was going to say about, yeah. It doesn't make sense, even when something like, the copper story or the gold story sounds so great, doesn't make sense to jump with both feet into any of these things. So what I keep repeating over and over again with every piece of investment advice on Substack is this little boilerplate paragraph that says, there's potentially a very serious disruption coming in the short run, and you don't want to be overexposed to anything. So use lowball bids and buy a little bit of this thing just to put some skin in the game, and then pay attention and learn about it as you go on, or sell covered puts or dollar cost average. Use the tools that allow you to gradually get into something, rather than just buying a whole bunch of it right away because it sounds so great, because that's a recipe for losing badly, and then just losing your faith in the whole concept of investing going forward. But if you add gradually into a trend that's probably going in the right direction, then it all works out for you. So do it that way, and you'll basically be okay.
Thank you so much. That is such important advice, and that's what you provide, and that's steeped in all of your analysis, your portfolio, and I know what you've done for the years in your writings, your books, your experiences, and your advice and wisdom for everyone. So thank you so much. Really, I was really happy to be able to spend this time with you before the holidays. Again, everybody, I really urge you to check out rubino.substack.com. John, I hope we can continue this discussion into 2025.
Thanks, Nomi. Looking forward to talking to you again.
Thank you. And everybody, thank you for tuning in to Prinsights.